Imagine a room containing the collective intellect of the modern age. PhDs from MIT, quant teams whose algorithms breathe in nanoseconds, and fund managers overseeing trillions in capital. Everyone in that room is operating with one objective: precision. Mainstream financial theory suggests that this concentration of intelligence makes the market safer. The logic is simple. If brilliant minds identify risks early, they can neutralize them. Better analysis leads to better outcomes. Better information creates better decisions. We've been taught to view the market as a global IQ test, a system that rewards the informed and punishes the unprepared. It sounds perfectly rational. It is the bedrock of modern financial institutions. But it ignores the dangerous mechanics of consensus. Markets do not break only because of a lack of information. Sometimes they break because a critical mass of intelligent actors reaches the same conclusion at the same time. The problem isn't always ignorance, the problem is structural synchronization, when too many sophisticated players begin to think, hedge, and react in the same direction. Look at 2008. The collapse of the housing market wasn't a complete surprise to insiders. Warnings about subprime fragility and structured finance were already part of the professional conversation. The data was available. The logic was sound. What made the system unstable wasn't simply the failure to see the risk. It was the fact that many major participants were exposed to different versions of the same structure and often used similar instruments to hedge, insure, or profit from the same outcome. Why does this matter? Because a market is not a truth-seeking machine. It is an expectation pricing machine. The moment a risk becomes obvious, it stops being mere information. It becomes positioning. Investors hedge around it. Funds rotate around it. Traders build escape plans around it. And when enough people plan for the same exit, the danger is no longer just the original risk. The danger is the narrowness of the door itself. Intelligence does not automatically strengthen the system in this scenario. It can make the system brittle. In a crowded trade, your analysis is not always a shield. Sometimes it is the fuel for the volatility that follows. When everyone thinks the same. Every market begins with disagreement. One person buys because they see a future. Another sells because they see a ceiling. This tension is not a flaw. It is the fundamental reason the system functions. Disagreement is the market's ultimate shock absorber. But in finance, we are witnessing the death of that diversity. Professional investors are increasingly pressured to look more and more alike. Academics call this institutional isomorphism. In markets, it means career risk forces players to adopt similar strategies, similar language, and similar risk controls as their competitors. Nobody wants to be the only one standing apart when the crowd is making money. As long as views are dispersed, the market is resilient. Different people move for different reasons on different time horizons with different definitions of risk. Some see weakness as opportunity, others see it as a reason to exit. That difference creates liquidity. It gives the market another side. But once a narrative becomes dominant, price stops reflecting reality and starts reflecting alignment. Early investors find a truth. Their success acts as confirmation. That confirmation attracts the crowd. The crowd pushes the price higher, which verifies the thesis again. Eventually, the idea becomes so widely accepted that the market loses its most vital asset, the other side. You no longer have a market of buyers and sellers. You have a market of holders. Buyers create demand. Holders protect territory. They are sensitive, they are leveraged, and they are all watching the same indicators. When the narrative finally shifts, there is no one left to sell to because everyone already owns the idea. The shock absorber has vanished. The market is now rigid, one-sided, and far less able to absorb stress. It may still look stable, but it is waiting for the first crack. The trap that forces investors into bubbles. If the risk is visible, why does the capital keep flowing toward the edge? Because in professional investing, it is often safer to be wrong with the crowd than to be right by yourself. This is the relative performance trap. A fund manager can see the bubble clearly, refuse to participate, and still lose everything professionally before the bubble ever bursts. If they sit out the rally and the market continues to rise, clients leave. Assets shrink, performance looks weak, their reputation suffers, their career becomes the risk, so they are forced to participate in a form of rational insanity just to stay in the game. This creates a psychological feedback loop. Investors stop asking only whether the price makes sense. They start asking whether they can afford to be the person who disagrees. And that question changes everything. It turns market risk into career risk. It turns discipline into underperformance. It turns caution into something that looks like incompetence. That is how bubbles survive longer than logic says they should. The crowd keeps moving because every individual inside the crowd has a reason not to stop first. Then the narrative takes over. We stop looking at the balance sheets and start looking at the new era story. We convince ourselves that the old rules of valuation are obsolete because technology has shifted the paradigm. Whether it was the radio in 1929, the internet in 1999, or artificial intelligence today, the story provides the comfort. And sometimes the story is partly true. That is what makes it dangerous. The narrative justifies the price. It allows sophisticated people to believe they are not gambling. It makes the trade feel intellectual, even when the structure underneath is becoming more fragile. But a story does not change the physics of liquidity. When the music stops, the new era does not provide more exits. It does not create more buyers. It does not make the doorway wider. It simply ensures the room is at maximum capacity when the lights go out. How markets became a feedback loop. In the past, markets had friction. News traveled with a delay. Information was processed through different cultural, geographical, and institutional lenses. A trader in London did not instantly know how a fund in Tokyo was reacting. A portfolio manager in New York did not always move on the same signal at the same second as everyone else. This lag was not just inefficiency, it was a form of protection. It kept markets unsynchronized. Today, friction is dead. We live in a world of total informational transparency and real-time execution. Central bank speeches are passed by LLMs in milliseconds. Earnings calls are transcribed before the speaker has finished framing the quarter. Risk systems monitor volatility, correlation, liquidity, and positioning continuously across every time zone. We have automated the consensus. This is not just efficiency, it is mechanical synchronization. And synchronization is the mother of volatility. When everyone watches the same volatility trigger, the market stops being a negotiation and starts being a feedback loop. A price decline raises volatility. Higher volatility triggers de-risking. De-risking creates selling pressure. Selling pressure pushes prices lower. Lower prices trigger more systems to react. At that point, the market is no longer responding to information. It is responding to itself. Think of the 2010 flash crash. Billions in market value vanished within minutes, not because of a war, not because of a recession, not because the real economy changed in those few minutes, but because the system crossed a structural threshold where one algorithm's reaction became the next algorithm's input. Modern markets are designed for speed, but they are not always designed for diversity. We have built a high-speed racing car with no brakes, and the driver is simply following the taillights of the car in front of him. As long as the lead car keeps moving, everything appears under control. But the second he taps the brakes, the pile-up becomes very difficult to stop. This is why so many sell-offs feel confusing in real time. People look at the headline that supposedly triggered the move and think, that should not have caused this much damage. And often they are right. The trigger is smaller than the reaction, but the structure underneath is so brittle, so aligned, and so fast that it does not need a catastrophe, it only needs a push. Why being right is not enough. Here is the most uncomfortable truth in finance. Being right is not enough. You can identify the trend. You can see the bubble. You can be completely correct about the future of the world, and you can still be wiped out if you arrived at that conclusion along with everyone else. Wall Street does not reward truth. It rewards the gap between what turns out to be true and what was already expected. If the truth is already priced in, your knowledge has very little value. This is why intelligence can become a trap. Smart investors often believe that if their logic is correct, the market must eventually obey it. But the market has no obligation to reward correctness on your timeline, and it has even less reason to reward a truth that everyone else already owns. As our data gets cleaner and our AI gets smarter, we are not automatically making markets safer. We may be making them more brittle. Shared understanding leads to shared positioning. Shared positioning leads to crowding. And crowding destroys the flexibility required to absorb shocks. A fragile market does not need a catastrophe to break. It only needs a disappointment, a slightly higher inflation print, a slightly more hawkish tone from a central bank, a weaker earnings outlook. A small rock that starts an avalanche because the mountain is already made of loose snow. The most dangerous markets are not always the ones that look irrational. Often they are the ones that look disciplined and coherent, where the narrative is seamless, where the data appears supportive, where every expert seems to agree. That is when the room is the most crowded. That is when the exit is the smallest. The market is strongest when we are arguing. It is weakest when we are certain. We think we have solved the problem of ignorance, but we may have created a much more subtle problem: alignment. The lights of the stock exchange are not showing us the future. They are merely reflecting our own consensus back at us. The market is not balanced. It is simply waiting for consensus to break, and the longer it waits, the louder the silence becomes. If you want to survive the next cycle, the answer is not to find more data. It is to find more distance. The value of the observer on the roof is not that they see more, it is that they see differently.